Hello and welcome to Understanding Financial Information Training. Today we will discuss the definitions of profitability and liquidity, which financial statements show the profitability and/or liquidity of a business, and an example of a family-owned restaurant business. In this example, you will have the chance to apply the definitions of profitability and liquidity and demonstrate what you have learned about financial statements. Owners, investors, managers, and stakeholders need to understand a business's profitability. What is the difference between profitability and profit? Profitability is a measurement of efficiency and ultimately a business's success or failure. Profit is the difference between revenue and expenses. Revenue is the money brought in as a result of sales and/or services. Expenses are money paid out to make businesses' operations happen. Expenses include paying people, renting a building space, and purchasing products. Look at the example here. In year 1, the business brought in $75,000 in revenue and spent $84,000, $35,000 in anticipated expenses, $2,000 in depreciation, and $47,000 in other expenses, resulting in a $9,000 loss. In year 3, the business generated $133,000 in revenue and spent $127,000, $53,000 in anticipated expenses, $2,000 in depreciation, and $72,000 in other expenses, resulting in a $6,000 profit. Please remember, when a business spends more than what it brings in, it has a loss. When a business spends less than what it brings in, it has a gain. The operating profit is an important line item. When we hear stakeholders say, "I only care about the bottom line," it means they only want to know if the business is making a profit or not. Which financial statements show the profitability of a business? Although financial information can be communicated through graphs and charts, this presentation shows financial data in numeric form as it appears on traditional financial statements to communicate key financial issues. The financial information statement that you see here is called the income statement or the profit and loss statement. It is the financial statement that directly shows the profitability of a business. Here is an example of the 4-year income statement that shows revenue, expenses, and profits or losses of a business. Year 1 and year 2, the business had a deficit of $9,000 and $7,000, which means the business operated at a loss during the first 2 years. Year 3 and 4, the business generated a positive profit of $6,000 and $19,000, which means the business operated in gain or profit during year 3 and year 4. Please remember, revenue is an important factor in determining the profitability of a business. As you can see in this example, revenue growth year over year from $75,000 in year 1 to $88,000 in year 2 to $133,000 in year 3 and to $231,000 in year 4. Therefore, business was able to reduce its loss in year 2 and generated profit in year 3 and year 4. Understanding the key factors determining the profitability assists leaders in developing an effective profitability statement for their business. Liquidity. What is liquidity? Liquidity refers to the ability of a business to keep its current asset balance, to pay its current liabilities, so that operations are not disrupted by cash shortfalls. Current assets in this example are cash and receivables. Receivables are considered current assets because it is money a business expects from customers within 30 days. Current liabilities in this example are payables. A simple question to ask is, do we have enough cash to pay our bills? Why is liquidity important? Many businesses crash because they run out of cash. Cash is the water that keeps a business from dying of thirst. Having the ability to pay bills in the coming months is extremely important to a business because even businesses that have a good plan for the long term may have to close their doors because they don't have enough cash. In this example, the current assets are cash and receivables. The current liabilities are payables. Please look at year 1 and year 2 in this example. In year 1, total current assets are $44,000, $43,000 in cash plus $1,000 in receivables. The total current liabilities are $9,000, which are payables. With current assets totaling $44,000 and liabilities of $9,000, this business has the ability to meet its short-term financial obligations. As you can see, $44,000 minus $9,000 gives us $35,000. This means this business is liquid. Now look at year 2. In year 2, total current assets total $27,000, $26,000 cash plus $1,000 receivables. The total current liabilities are $9,000, which are payables. With current total assets of $27,000 and total current liabilities of $9,000, the business does have the ability to meet its short-term financial obligation in year 2. $27,000 minus $9,000 equals $18,000. This business is liquid because after paying off its payables, it still has $18,000 in the bank. Here is a question to think about. How do we determine a business's liquidity? Of course, the answer is that we look at the difference between the total current assets and the total liabilities. Remember, total current assets include cash and receivables, and total current liabilities include payables. Which financial statements show the liquidity of a business? A balance sheet is a financial statement that summarizes a business's assets and liabilities and shareholders' equity at a specific point in time. If users want to know whether a business has enough cash or current assets to pay its upcoming bills or current liabilities, they will need to look at the balance sheet. Here is an example of the balance sheet that shows a 4-year period. How financial statements illustrate issues. Financial statements are designed to communicate useful information about the operation and position of a business. They are the most objective way to access the health of any business. Information from financial statements can indicate a business's profitability or poverty. Financial statements come in many forms. In this training, we will focus on the 2 most important statements, the income statement and the balance sheet. How financial statements illustrate issues continued. If users want to know if a business is profitable or not, they look at the income statement. Please take a look at the income statement. You can see that in year 1, this business operated at a loss of $9,000. In year 2, it continues to operate in a loss of $7,000. But by year 3, it generated $6,000 in revenue beyond liabilities, and in year 4, it brought in $19,000 in profit. Remember, when you want to know if a business generates profit or not, you just need to look at the operating profit line, or, like many stakeholders say, the bottom line. If users want to know if a business has cash to pay its upcoming bills or not, they look at the balance sheet. Please take a look at the balance sheet. In year 1, current assets totaled $44,000, $43,000 cash and $1,000 receivables, and liabilities totaled $9,000, which is the payables. If we subtract liabilities of $9,000 from the total current assets of $44,000, we have a balance of $35,000. This means the business is liquid because after paying off its payables, it still has $35,000 cash in the bank. In year 2, current assets totaled $27,000, $26,000 cash and $1,000 receivables, and liabilities totaling $9,000, which is the payables. Subtracting liabilities from assets leaves a balance of $18,000. This means the business is liquid because after paying off its payables, it still has $18,000 cash in the bank. In year 3, current assets total $34,000, $33,000 cash and $1,000 receivables, and liabilities totaling $12,000, which is the payables. Subtracting liabilities from assets leaves a balance of $22,000. This means the business is liquid because after paying off its payables, it still has $22,000 cash in the bank. In year 4, current assets total $97,000, $96,000 cash and $1,000 receivables, and liabilities totaling $17,000, which is the payables. Subtracting liabilities from assets leaves a balance of $80,000. This means the business is liquid because after paying off its payables, it still has $80,000 cash in the bank. Please remember, current assets minus current liabilities equals net liquidity. If current assets are more than current liabilities, the business is liquid. If current assets are less than current liabilities, then the business is illiquid. Example: we have discussed profitability and liquidity and how financial statements illustrate issues. Now we will look at an example of a Venice Italian cuisine restaurant. First, let's talk about the background and history of the Venice Italian cuisine restaurant. The Venice Italian cuisine restaurant is owned by Mr. and Mrs. Epicito. The Epicitos focus on the goals of quality, healthy, and tradition. The restaurant's values are 1. Honor the customers, and 2. Serve quality food by making each dish from scratch. Please note, to start this business, the Epicitos obtained a $100,000 commercial loan from Wells Fargo and used that money to purchase the restaurant's kitchen equipment, furniture, and decorations, and began hiring kitchen and floor staff. Example continued. Here you see two financial statements. The first one is the income statement, and the second is the balance sheet. These are the same two statements that we discussed in the previous slide. Now let's talk about profitability. In order to understand whether the restaurant is making a profit or not, the Epicitos need to track both money received and money expended in a given time period. This information is obtained from the income statement. Money received is money brought in as a result of activities such as sales and services. This is also called revenue. Money expended is money that is spent to generate revenue. This is also called expenses. The income statement is a running tally of money that flows during a time period. Year 1. The total revenue earned was $75,000. The total expenditures were $84,000, which included $35,000 for labor, $2,000 for depreciation, and $47,000 for other expenses. After subtracting the $84,000 expenditures from the $75,000 revenue, the Epicitos lost $9,000 in the restaurant's opening year. Remember, income statements focus on revenues, expenses, and the profit or loss report that is generated from subtracting the expenses from the revenue. Revenue minus expenses equals profit or loss. This is very important for the Epicitos to know because it tells them how his restaurant is doing during a given time period. Remember, when a business spends less than it brings in, it makes a profit. When a business spends more than it brings in, it has a loss. Now, let's talk about liquidity. A business's liquidity is its ability to meet its short-term financial obligations as they come due within a 12-month period. Liquidity considers cash that the restaurant has in the bank at the end of each year. Please note, this number may have gone up or down during the year. To assess the business's liquidity, the Epicitos need to look at two things. One, how much current assets the restaurant has, which includes cash and accounts receivables, and two, how much current liabilities the restaurant is due in payables, such as what is owed to the suppliers. Please remember, cash plus receivables minus payables equals net liquidity. Let's look at year one. In year one, total assets were $44,000, which included $43,000 cash and $1,000 receivables. Total liabilities were $9,000, which included $9,000 payables. This left the restaurant $35,000. Current assets minus current liabilities is equivalent to $44,000 in current assets minus $9,000 in current liabilities to give you $35,000. This means the business is liquid. In this section, we will compare the Venice Italian Cuisine restaurant with the Oregano's restaurant. Although the Venice Italian Cuisine restaurant has been liquid since year one, it did not make a profit during the first 2 years. This really worried the Epicitos. Mr. Epicito understands that it is normal for a new restaurant to operate with a loss during the first 3 years. However, when the restaurant operated at a loss during year 2 and made very little profit in year 3, the Epicitos decided to do a competitor analysis. This analysis lets the Epicitos compare their restaurant with their customers. They hope to identify differences that could make their business more profitable. After identifying the Oregano's restaurant as one of the biggest competitors to the Venice Italian Cuisine restaurant, the Epicitos decided to focus on the Oregano's customer target, marketing strategy, market share, prices, menu, image, and growth. The Epicitos' main focus in marketing was to increase customer awareness in the surrounding communities. The Epicitos hoped that word of mouth would be the main marketing force. The Epicitos created an appealing environment with exceptional prices using a high quality and diverse menu. In year 4, Mr. Epicito was able to use the analysis to make changes in the Venice Italian Cuisine restaurant. Instead of serving only dinner from Tuesday to Sundays, Mr. Epicito decided to also serve lunch, have the restaurant open 7 days a week, and add delivery services. Mr. Epicito changed his menu to offer a wider range of items for both service times, while continuing to offer superior food quality and keep the menu prices under $20. By the end of year 4, the restaurant's reputation had spread throughout the community. Its name became synonymous with delicious Italian food. Customers enjoyed the fine dining experience and upscale ambiance at Venice Italian Cuisine. Customers found the prices reasonable and were happy with the delivery and diversity of the menu. Compared to year 1, revenue in year 4 for the Venice Italian Cuisine restaurant increased from $75,000 to $231,000. Of course, the more revenue the restaurant earned, the more expenditures it incurred, as seen in the increase in labor costs from $35,000 in year 1 to $95,000 in year 4. Other expenses also increased from $47,000 in year 1 to $116,000 in year 4. Now, let's review the profitability and liquidity by comparing the two restaurants. Ask yourself questions regarding profitability. Was the Venice Italian Cuisine restaurant more profitable in year 1 than the Oregano's restaurant? The answer is both restaurants had the same loss of $8,000. How about year 2? The Oregano's restaurant did better, as it showed a profit of $1,000, while the Venice Italian Cuisine showed a loss of $7,000. How about year 3 and 4? Was the Venice Italian Cuisine restaurant more profitable than the Oregano's restaurant in year 3 and year 4? Of course not. Now ask yourself questions regarding liquidity. How do you determine the restaurant's liquidity? We will look at the total current assets and the total current liabilities. If a business has more assets than liabilities, it is liquid. If a business's total current assets are less than its total current liabilities, then it is illiquid. Does the Venice Italian Cuisine restaurant have more liquidity than the Oregno's restaurant in year 2? Of course. Can you explain why? In year 2, Venice Italian Cuisine had assets of 27,000 and liabilities of 9,000. It has liquidity because after paying off its payables, it still has 18,000 cash in the bank. In year 2, Oregno's restaurant had assets of 15,000 and liabilities of 16,000. Oregno's restaurant is illiquid after paying off its payables by $1,000. Please take a few minutes to make sure you understand the definitions of profitability and liquidity, and which statements to look at when you are answering profitability and/or liquidity questions. We are done with our training section. Now, in this slide, I will show you how to maneuver the financial statement. When you open the link regarding the kitchen and saltwater restaurants, you will see this page. This page will have all of the information that you need to complete your questionnaire regarding the kitchen restaurant, and also the comparison of the two restaurants. If you want to make the screen smaller or larger, all you need to do is hold down the control button and the plus or minus sign. Please review the information from these statements carefully and complete your survey questionnaire. Thank you so much for watching this video training and completing the survey questionnaire.